You want to know what are the best stocks to buy now? I've got 5 stocks that I'm buying right now. Let's go. AMD topped out at $227.30. It's down 35% in the past year. Now, from the very peak, AMD has actually declined 49%. That was March 2024. Over that same period, Nvidia stock has increased over 40%. Now, in Discord, we were trimming AMD $200 plus. We were buying Nvidia $100 and less. But what about now? Is AMD stock a buy right now at $110 a share? AMD just reported earnings on February 4th. Now that non-GAAP EPS of $1.09 was in line. Revenue of $7.7 billion, up 24.2% year over year, was a beat by $170 million. Data center revenue soared 94% for the year to $12.6 billion. And that number included GPU sales of over $5 billion. So data center revenue surged 69% year over year and 11% sequentially to $3.9 billion. So AMD's Instinct GPUs and the EPYC CPUs helped drive that growth. The problem is that analysts were expecting $4.14 billion and we got $3.9 billion. Now let's focus a second on CPUs. When we think of data center, we're always talking about GPUs and not necessarily CPUs. So AMD's EPYC CPUs continue to gain market share in data center. In fact, among the hyperscalers, AMD now has a market share of well above 50%. And meanwhile, AMD told us that Microsoft and Meta are using its GPUs. Now, a big thing to keep an eye on here in 2025. In the middle of the year, AMD is going to release its next gen series GPUs. And then, of course, another model in 2026. With that said, AMD right now is struggling to compete against Nvidia in the GPU space. Now, why is that? It really comes down to the software ecosystem. We talk about it all the time on the channel. Nvidia has that soup to nuts ecosystem, which is very hard to compete with. So it's very unlikely that AMD is going to make huge strides against Nvidia and GPUs, although there is market share to be taken. AMD just does not have that software platform to compete against Nvidia's dominance, especially when you talk about training. Now, the next step to training is going to be inference. And AMD has carved out a nice niche when you think of AI inference. And when you look at AI inference, there's also going to be edge inference. So computers, smartphones, and other devices will soon run AI software independent of external data centers, like going up to the cloud. AMD's Ryzen AI 300 series chips for PCs were bred exactly for this purpose. Eventually, every computer and device will have the ability to run AI workloads. So I believe that AMD is on the cusp of a multi-year opportunity. For each stock today, we're going to look at financials and a chart as well, but I think AMD is a buy. I'm going to show you some price levels. The reason is that it's the leading data center CPU company. CPUs do play an important role in the data center, although it's not as important or as large as GPUs. But in the future with inference, especially with the edge, you're going to hear CPUs and NPUs often. So you want to know, your question is why is AMD stock down so much? What is the deal exactly? We saw that earnings were good, although data center did miss, and that's a big part of it. There was a lot of excitement baked into the stock price, and it just got ahead of itself. Once that sentiment turns, some people lose money, they're down 40-50%. Well, that negative sentiment just snowballs. On top of that, the guidance was a little bit weak, a 7% decline in its revenue for the first quarter of 2005, citing seasonality. Now remember that AMD is still big in gaming, and that segment overall is down across the board. Net revenue is down 58% and operating income down 70%. On top of that, embedded was down 33% and the operating income down 46%. Looking at some of the financial metrics on Seeking Alpha, profitability grade A- strong. The growth is an A, also strong. Valuation can get a bit interesting. You're going to see this non-GAAP forward often 23.27. Now we like to look at the gap, and that forward gap PE ratio is 43.6. Forward price to sales is 5.62. So at $111 a share, you're looking at $179 billion market cap. There's also 3.64% short interest. The 52-week range is $106.50 to $227.30. Looking at a chart, we said it was overvalued when it was $200 plus. When it sold off to $175, we said it was still overvalued. Back in 2024, we said AMD stock was worth between $100 and $105 a share. Now we've had several earnings reports since then, so paying $111 a share, That doesn't look too bad to me. So you can see when it got down to that $106 level, it just broke the Fibonacci S2. That S3 support 3 is around $101 a share. I told the gang in Discord it's possible the stock could break $100 a share, but if I'm accumulating shares at these prices and lower, I feel pretty good about it over the next couple of years. I believe there's a good chance that the stock could be worth $200 to $250 over the next 2 years. So AMD stock is a buy now. The lower, of course, the better. DCA, dollar cost average. The second stock on the list is closely related to pick number 1, AMD, another semiconductor name. On this channel, we've been talking about the different phases of Gen AI. Phase 1 is the infrastructure phase, Nvidia, Broadcom, Marvell, building out the LLMs. The second phase is going to be connecting the LLMs to enterprise data. The Palantir, Snowflakes, MongoDBs, Elastic. Now, as we get to phase 3, and these AI applications are actually being pumped out to consumers, inference is going to be huge. And a big part of that is going to be edge inference. Not only processing data closer to devices, edge services, but also NPUs, where you're processing the data on the device itself. Qualcomm is positioned to be a leader in this space. Now, with any investment, there's always going to be risks, and Qualcomm would be much higher if it weren't for this primary risk. Apple might, and there's a big might there because it's not for sure, replace Qualcomm, which is $7.7 billion revenue impact by FY 2028. Now, with that said, automotive and Internet of Things, talking about the edge cloud and all those different things, could offset the potential revenue loss from Apple. These segments are projected to grow at a whopping 26.6% and 28.1% respectively, reaching 49% of total revenue by FY 2028. Now, if that happens, these segments would replace this lost revenue, but there's also a chance that Qualcomm doesn't actually lose the revenue from Apple. Apple has threatened things like this many times, and oftentimes they don't come to fruition. So Qualcomm has strong profitability, A+, 55.99% gross profit margin. The growth isn't stellar, but this is a dividend payer, so this is more of a DGIF, pays around 2% dividend yield. Valuation-wise, looks attractive to me. So non-GAAP forward PE is under 15, and that GAAP forward PE is 17.53. The PEG ratios also look good here, and that price to sales, 4.69. Forward price to sales, 4.37. So this is a $189 billion market cap, has 2.17% short interest, pays that 2% dividend yield. It's up about 12.69% in the past year. And you can see this was a $230 stock, the 52-week high, 52-week low, 148.41. Under $150 is definitely a strong buy. Let's look at a chart, and I'll tell you where I think Qualcomm is a buy now. So back in June of 2024, Qualcomm was $230 a share, and I said I wouldn't touch it over $175 a share. So now you're talking over a half a year, around 8 months, and you can buy it below $175 a share. Now, my preference to buy this stock is in this orange circle, and that's basically between 145 and 162. I really like Qualcomm $165 or less DCA, but even as a long-term investor, if I look at this at $172 a share, it's a quality company that should compound in your portfolio. Now, this is not going to be hyper growth, and there are risks to it. So as we said, Qualcomm is a dividend payer, not a hyper-growth stock. This is definitely a hyper-growth stock. Wait till you see the blowout earnings from last night. Now, Astera Labs is all about that data center and really phase 1 infrastructure. This was a new IPO in 2024. This is all about high-speed connectivity, so integrated circuits, modules, and boards. And their Cosmos system, connectivity, system management, and optimization software. Q4 non-GAAP EPS 37 cents, beat by 11 cents. The revenue, 141.1 million, that beat by 13.19 million. And the growth, 179.4% year over year. So the ticker is ALAB, ALAB. It's a semiconductor-based connectivity company. The report beat 10.4% above street, and those estimates were pretty aggressive. And the guidance was a raise of 14.9%. This is a Needham analyst, Bolton, and he has a buy rating, $140 price target. And a quote here, "We remain buyers as ALAB is set to benefit from momentum across multiple products, with Taurus likely growing greater than 60% year over year in 2025. We continue to believe that our estimates could prove conservative for 2025 and 2026. 2026. But this earnings report absolutely crushed it. You can see really a beat across the board. The only thing that wasn't a beat is next quarter guidance. The operating income margin percentage was slightly lower by 1%. You can see the stock is down about 11% today at $92 a share. It's not a profitable company, so keep that in mind. Now, the valuation here, it's sky high. I'm not going to beat around the bush. It's expensive. It does have a non-GAAP PE of forward of 88.81, but the PE gap is 1,600. And the price to sales, the forward here is 23.62. That's come down considerably. In fact, before this earnings report, it was over a 40. So the idea here with this company, it is a bit speculative, but it's really a hyper growth stock. And a hyper growth stock, as long as that momentum continues, it can grow into its valuation very quickly. There's certainly risk to that. And this is a $16.38 billion market cap. It does have 5.0% short interest, 52-week range, $36. Of course, it'd been much better to buy it at $30 versus $90. The 52-week high was $147.39. So this has come back significantly from those highs. I'm buying this stock right now in the community portfolio. Now remember that community portfolio is pretending that I'm 25 years old. I'm in the accumulation phase and I'm willing to take risks. It's an aggressive growth portfolio. There are certainly risks to this stock. You can see this was a new listing here back in March of 2024, topped out at 147. Most recent low here, that DeepSeek sell-off, January 25th, whatever date it was, $79.55. Now, ideally, I'd like it to come back in that range. In the 70s would be ideal. But I do like this stock, $100 or less DCA as a long-term investment holding 5 or more years, and I would treat it as spec, meaning it could be a 10x or a 0. Of course, with a stock like this, you have to DCA, and the lower, the better. But I do believe $100 or less over a 2-year period, I think you're going to make money. A reminder that none of this is financial advice. I'm just sharing what I'm doing with my portfolios. Now, I've got 2 more stock picks. If you're new here, make sure you subscribe to the channel, smash that bell for notifications so you don't miss a video. And if this video is helpful, please return the favor and drop me a like and drop me a comment. Let me know what you're buying right now. The 4th stock today is super interesting. Now, I used to own this stock. It is the best of breed when you think of SaaS, HCM, human capital management. I think this is absolutely brilliant, and I think it's ahead of the curve. I do think that the street, Wall Street, is going to jump on this very soon. The next generation of workforce management is here. Workday unveils new agent system of record. So this is built to help organizations, enterprises manage their entire fleet of AI agents. We've been talking about agentic AI and AGI. This is the future, and Workday is going to try to help businesses manage these AI agents. So these are AI agents from Workday and third parties alike in one place. I believe there will be a need for this. It's something I actually mentioned when we did the Nvidia video talking about NIMs. Now, other SaaS players like Salesforce CRM will also be beneficiaries in this space. I've owned that stock for years. I'm buying Workday, and my primary taxable brokerage is the $2.6 million account. So as the number and complexity of AI agents grow, organizations of all sizes face a new set of challenges. Managing their deployment, ensuring their security and compliance, optimizing impact, and managing costs. Without a centralized approach, they risk fragmented operations, increased security risks, and difficulty measuring the true value of their AI investments. I think this is brilliant, and I'm buying this stock today. And real quick, something else to point out is that Workday is laying off 1,750 employees. And this is for the company shifting towards artificial intelligence. Salesforce recently did something similar, 1,000 job cuts while expanding AI hiring. So I posted this in Discord this morning, the second channel from the top. If you're interested in joining us and seeing when I buy stocks in real time, everything I buy and sell in my 3 portfolios, go to the pinned comments and click that link for Patreon, Discord, and join us. We're the best investing community on the planet, hands down. And joining our community is a fabulous investment. Give us a try. So looking at the SaaS metrics for Workday, the EV/NTM revenue is a 7.2. That's pretty reasonable. In fact, if you look at the overall median, it's 6.2x. So it's slightly higher, but look at, names like Palantir, 75, Cloudflare, 23, and so on. The LTM, so last 12 months, rule of 40 is 43%. That's a solid number. Next 12 months is a 39%. Free cash flow, 26%. This is a profitable SaaS company, which is rare. This has that recurring revenue. The PE here is 37.67. Short interest is 4.2%, and the market cap is $71.79 billion. Now, this is a SaaS company with recurring revenue, so it is going to have an expensive price to sales, but just for reference, the forward is 8.53. 52-week range, $199.81, and $311. It's trading at $263 right now. And it is down 12% over the past year. It's up 37% 6% over the past 5 years. This is not a hyper growth stock. In fact, it's more of a mature company, and I believe it could be a dividend payer over the next couple of years. It's a high quality name, and I do believe there could be a boost to revenues from this new product. So you can see we've come back to this yellow line. This is the 50-day simple moving average. The fib range here is really between $230 and $290. Now the big DeepSeek sell-off, we saw $244.88. That's my preference, below $250 dollar cost average. I did start a small position today around these prices. Stock pick number 5. I'm going to take you to the danger zone. Now keep in mind, this stock carries a little bit more risk than your average stock. This stock has been hammered, and the last earnings report wasn't all that great. In fact, guidance wasn't really that great either. Now you're looking at energy infrastructure, factory automation, electric vehicles, AI data center, advanced safety. Now look at your screen. Energy infrastructure, electric vehicles, and advanced safety. Those are 3 of the primary growth segments, and that total TAM is $44 billion. But these areas are in a down cycle. Now, when you invest in a stock like on Semi, you're investing thinking 2 years out. Similar to Peter Lynch when he's trying to buy cyclicals when they're beaten down and then ride them up. Now, there's risk to this because the stock can certainly go a lot lower. Solid profitability, A-. The problem is the growth is not there right now, but we believe that it will accelerate again in the near future, probably not till the back half of 2025. Now, valuation-wise, it's very attractive. You've got a non-GAAP PE of 17, a forward GAAP PE of 21. Forward price of sales around 3.28. $20 billion market cap. This does have about 6.7% short interest. 52-week range, 85 to 46.57. So it just had a 52-week low. I believe this stock will be $85 again within the next 18 months. Looking at the chart, you can see that it broke the S2, 47.66. Post-market, it's slightly above it. Now, it could go lower. This Fibonacci S3 sitting at $41.86. It's very possible that you see $40 to $45. I told everybody in Discord the same thing. It could even break $40. Now, back in August of 2023, this was $111 a share. And I'm not saying it's going to go back there anytime soon, but I definitely see the possibility for 75 to 85 over the next 18 months out of the other end of this cycle. Do your own homework and make your own decisions. If you're new here, make sure you subscribe to the channel, smash that bell for notifications. If this video is helpful, drop me a like, drop me a comment. Have a great rest of your day. Take care.